Yesterday, crude oil printed $91.48 on the high. By the close, it was at $83.45. That's an $8 collapse inside a single session. This morning, pre-market, it's already trading at $85.40, up 2.5% from yesterday's close, like none of that happened. When a market behaves this way, it isn't broken, it's telling you something. The question is whether you're reading the price or reading what the price is responding to. Those are not the same thing. Today, that distinction is the whole game. Most people watching oil right now are focused on the wrong variable. They're watching inventory forecasts, OPEC headlines, dollar moves. Those things matter. They'll matter today, but they're operating inside a larger structure that currently overrides all of them. That structure is the Strait of Hormuz. 20% of global seaborne oil passes through that chokepoint, 6 to 7 million barrels per day out of Saudi Arabia and the UAE. Right now, that passage is under active threat. The US-Iran conflict is not background noise. It is the market's primary input. Everything else, the API draw, the OPEC production adjustment, the DXY, is a secondary signal inside a geo-premium framework. Understanding what a geo-premium actually is matters here. It's not a rational valuation. It's a fear surcharge. The market is not pricing what oil is worth today. It's pricing a distribution of scenarios, some of which involve a major supply disruption, some of which don't, and weighting them by probability and consequence. When you see a $14 range in a single session, that's not noise. That's the market recalibrating those weights in real time. The only credible near-term antidote to this premium is a coordinated strategic reserve release. The IEA has floated a release larger than the 182 million barrels deployed in 2022. Austria has already confirmed participation. The US is reportedly considering a major SPR draw alongside it. If that confirmation hits the tape today, the fear surcharge deflates fast, regardless of what Iran does. That's the one wild card that cuts against the geo-bid. The mixed signals from Washington aren't helping. The war is very complete on one side. We will blow up any ship on the other. That kind of contradictory messaging doesn't resolve uncertainty, it amplifies it. And amplified uncertainty in a market already running an ATR of $8 to $10 means the next headline in either direction lands harder than it normally would. Today has 3 live data events. They're not equal in weight. The most important is EIA crude oil inventories at 10:30 Eastern. The last print for the week ending February 27th was a build of 3.475 million barrels. Today's consensus is around plus 2.8 million. But here's the thing. Yesterday's API report, which is the advance read on the same data, showed a draw of 1.7 million barrels against a forecast of plus 1.4 million. That's a significant miss in the bullish direction. If EIA confirms a draw, or even prints substantially below consensus, the market interprets that as demand holding up and supply tightening despite the chaos. The path to $88 to $90 opens fast. If EIA instead prints a large build, above 4 million, that's the scenario where the geo-premium faces a reality check. Price could fade to $82 with conviction. The 10:30 to 11 o'clock window is the highest volatility 30 minutes of the day. Not the open, not the close, that window. The OPEC monthly oil market report is also due today. OPEC already approved a production increase of 206,000 barrels per day from April. No new cuts are expected. What you're watching for in the MOMR is the language around demand and supply balance, and whether there's any acknowledgement of the Hormuz risk in their scenario modeling. Downward revisions to demand or any softening in the supply outlook would land bearishly in the current environment. Third is CPI data, which matters less directly but feeds into FOMC expectations and dollar direction. DXY is sitting at 98.96, weak, which is a mild tailwind for crude. Oil is priced in dollars. When the dollar softens, the same barrel costs more in dollar terms for foreign buyers, which supports price. The 10-year yield at 4.136% is neutral for now. No pressure from rates. Before 10:30, what's your read? Draw or build? It's worth forming a view before the number hits, not to predict it, but to know in advance how you'll respond to each outcome. Reactive trading without a pre-formed framework is just gambling with extra steps. Yesterday's candle is worth understanding structurally. High at $91.48, close at $83.45. That's not a retracement, that's a rejection. Something hit $91 and got sold hard. Today's pre-market has already printed a low of $81.82 and a high of $88.91. The market has essentially rerun yesterday's range before the regular session even opened. That's what an ATR of $8 to $10 looks like in practice. In this kind of environment, standard technical levels lose some of their precision. They still matter, but volatility overrides structure at the margin. With that caveat, $80 is strong support. It's a round number, it's a psychological anchor, and large participants use it as a reference. $85 is the current point of control, the price at which the most volume has traded recently, and that's exactly where we're sitting now. $87.50 is the first meaningful resistance, aligning with the standard pivot R1. $90 is a ceiling. Above $90, there's no clear technical reference until $100 comes into view, which is a long way to travel on momentum alone. The opening range from 9:30 to 10 sets the directional bias for the session. Above $87.20, the long bias is valid. Below $82.80, the short thesis activates. The volume profile shows absorption at $83 to $84. Buyers stepped in at the lows and held. That's not panic buying. That's structured accumulation at a level someone decided was fair value given current conditions. COT data adds context. Commercial traders are net long. Speculative traders are net short. That configuration historically precedes a squeeze higher. The specs are leaning the wrong way, and the commercials are positioned for a move up. The futures curve is in backwardation, meaning the nearby contract trades at a premium to deferred. That's a crisis mode signal. The market is paying up for oil now, not later. The order flow layer is telling a consistent story. Pre-market delta is positive. Buyers are the aggressor on the way up from yesterday's lows. Bid walls are sitting under $83.50 to $84.00. Ask walls are stacked at $88 to $89. Those walls define the current contested zone. The options market is worth pausing on. There's heavy call buying at the 90 and 95 strikes for the near-term expiry. Those aren't hedges. Hedges don't look like that. Those are directional bets, real capital positioning for a continuation of the geo move. Max pain sits at $84 to $85, which is where price is right now. GEX is neutral, meaning there's no mechanical gamma-related pinning force in either direction. What that means practically: if price breaks cleanly above $85, there's no options market resistance until $90. In a market running $8 ATRs with a live geopolitical trigger, that move is not a tail scenario. It's executable on a single EIA headline. The call buyers at 90 to 95 might be wrong. They might be very wrong. But their positioning shifts the probability distribution. It's real capital expressing a view, and it changes the risk-reward calculus of the upside scenario. Not because they're smart, but because their positioning becomes a self-reinforcing input if price starts moving that direction. 2 scenarios, 1 plan. Scenario 1, EIA prints a draw or a build significantly below the 2.8 million consensus. No IEA or SPR release confirmation hits. The GeoBid holds. Delta stays positive through the EIA window, and the order flow above $87 is clean. In that case, the long setup is valid above $87.20. Stop at $84.50. First target, $88. If $88 breaks on volume with follow-through, the extension is $90. That's a clean $3 move with 2.70 of risk. Reasonable asymmetry in a high volatility environment. Scenario 2. EIA prints a large build above 4 million barrels, and IEA confirms a coordinated strategic release. The geo-premium deflates. Price breaks below the absorption zone at $83 to $84, and the bid walls give way. Short below $82.80. Stop at $85.50. Target $82, with extension to $80 if the selling accelerates. One discipline note that matters more than anything else here. Position size is 50% of normal. Not because the setups are weak, because an ATR of $8 to $10 applied to a full-size position is a risk management error. Volatility this elevated means your normal position is twice as large as it should be. The market doesn't care how good your entry is if the range can hit your stop and your target in the same 30-minute candle. Size down. Let the setup work. The power hour, 3 to 4 p.m. Eastern, is worth watching as a secondary window. Geo headlines often break in afternoon sessions, and if the day's range has compressed by mid-afternoon, a late directional move into the close is a real possibility. The market's job today is not to find fair value. Fair value doesn't exist when the world's most critical oil shipping lane is under active military threat. The market's job is to price a range of scenarios and reprice them as new information arrives. Your job is not to know which scenario plays out. It's to define your risk before it declares itself and to respond cleanly when it does. The traders who blow accounts in weeks like this aren't wrong about the direction, they're wrong about the size. One last thing, and this is said plainly, not as a formality. This is for educational purposes only. Nothing here is financial advice. Trading crude oil futures carries real and significant risk of loss. Do your own research, understand what you can actually afford to lose, and make your own decisions. That responsibility is yours, not mine.